tab for our budget. We're going to hit the plus sign and create a new tab. This is called retirement plans, different from the actual retirement where we calculated how much we would have in retirement based on saving our 10%. So retirement plans, we're talking about 3 different retirement plans here. Number 1 is Social Security. Social Security comes out of your paycheck. We talked about that in our income tab. So you'll see this FICA, Social Security 6.2%. This money right here is not a choice. It is going into our Social Security, and then it goes out to pay retirees who qualify at a certain age. So that money will hopefully it'll be there for us. But this is a government-sponsored retirement plan that is employee-funded. So we fund that by paying Social Security tax. Okay? So we will get a certain amount of money when we end up retiring at a certain age. So the maximum monthly, at what age can you start collecting? At 62. You can collect at 62, and then you can actually max out your benefits at age 70. So you can wait till age 70, you'll get a larger payout. That's the next question. What's the maximum monthly Social Security benefit? The maximum monthly Social Security benefit at 62, I want to say it's like just over $2,500 per month right now, and you'll get that for as long as you live. If you survive a spouse, you will get that money as well. And then if you wait until 70, I want to say it goes to right around $4,500 or just a little over $4,500. So you delay getting paid by 8 years. If you do that, you can make significantly more per month. But if for some reason something happens to you in the meantime and you never recoup any of that Social Security, it is just gone. That's why a lot of people do it at 62. But if you have the ability to use some other type of retirement and defer that until 70, you can get a much bigger monthly payout on that. 2 ways that you could fix Social Security. Social Security actually has a budget deficit, so they spend more money than they make, kind of like our budgets here. You could increase taxes. That would increase revenue. That's not going to be very popular. I don't like that idea. I don't like paying so much in taxes. We have a lot of taxes already. We could decrease expenses, so we could pay out less to retirees. Well, people who are depending upon these Social Security checks aren't going to like that idea whatsoever. And then there's some other options. You could be a little bit more creative about different things, such as raising the age or changing the age for qualifying, something like that, whatever that kind of looks like. But there's, again, 2 ways to fix a budget. You can increase income, decrease expenses. Changing the age could increase or decrease the income or expense, the expenses, depending on which way that you go about doing it. All right, so make sure you answer in red on those. I want you to write those questions out as well. Pause the video if I'm moving too fast. Next one, number 2, 401k. So 401k, what is a 401k? That is an employer-sponsored retirement account. Employer, not employee. If you work for a company, you're the employee. They are the employer. I work for St. James Academy. They're the employer. I am the employee. And the 401k comes from a line in the tax code. Okay, so basically, you get to put pre-tax money. So before you get the money, you never actually see the money. It's a deduction off of your paycheck, and you don't pay any taxes on it. It will go into your 401k. Then your 401k, you get to choose whether you want to invest in stocks, bonds, mutual funds, so on and so forth. But you don't pay taxes on it, so you can make capital gains and return on your investment with a greater amount. So it's really pretty cool. So instead of that money going to the government right away, it goes at the end when you actually withdraw your 401k. You can withdraw your 401k at 59.5. So pre-tax money means is that you don't pay taxes up front, you pay taxes at the end. So you get to use pre-tax money to invest. So that's pretty cool. Most companies match an employer's contribution. What does that mean? So like St. James has a 2% match. So if I put 2% of my salary in, I get a free 2%. So that means 4% of my salary goes into my 401k, which is pretty cool. It's kind of like free money. If your company offers you a 401k, I think you should, 401k match, I would definitely take care of the match. Whether 401k or Roth IRA or whatever is right for you, that's what you have to evaluate. But the more information you have about it, especially when you can double your investment like right away. If I put $2,000 into my 401k each year, I get $2,000 back. That's 100% return just right off the bat, which is awesome. It also lowers my taxable income rate. So for some people, that is worth it as well. There is a maximum amount that you can put in there. I don't hit that amount, but it's something like $20,000, $19,000, something like that. All right. Money you stash in a 401k isn't meant to be touched to retirement. Any money withdrawn could be subject to an early withdrawal penalty. That's 10%. So if you bring any of that money out before the age of 62, you get hit with a 10% fee, and then you pay taxes. So you might end up, if you had $1 million in account and you had to touch that all at 55, you might only end up at 10% fee, and then you pay taxes, state, federal, all that stuff. You might be looking at maybe getting $600,000. You might have paid $400,000 in taxes. Like, that's pretty significant. That'd be terrible. Don't do that. At what age can you access your 401k without penalty? It's 62. I told you that. 62 years old. So you need to wait until 62. And there's no reason that you can pull any of this money out for any other reason. This was set up so that you save it in retirement. For retirement, I should say. All right, third one, Roth IRA. This is my favorite one. I love it. Roth was a politician. IRA stands for Individual Retirement Account. That's the answer to the first question. What is a Roth IRA? It's an individual retirement account with super tax benefits. What is your annual contribution limit in a Roth IRA? It's $6,000. You can put in up to $6,000 per year. We did that on the retirement tab right here, right? This very last one. If we maxed out Roth IRA, that's $6,000 is $500 a month multiplied by 12, $6,000, 9.5% rate of return. Stock market has returned on average since its inception. Years to invest 42 from 23 to 65. And my retirement amount is over $3 million based on that compounding interest calculator that we use. That's pretty cool. That's what it's based off. That's where I get these numbers. I don't just make them up out of thin air. I have a plan. So a maximum annual contribution limit $6,000. After I think 50 or 55, you can raise it up to $7,000. They kind of change this too as inflation starts to go up. I remember when I started my Roth IRA, it was like $3,500 or $4,000 maximum per year, and then it went up to $5,000. Now it's up to $6,000. Roth IRAs have tax-free earnings. What does that mean? Oh my gosh, tax-free capital gains. This is awesome. So unlike the 401k, you don't pay taxes up front. You pay taxes at the end. Flip the script for Roth IRA. Roth IRA, you pay taxes up front. So you have those deductions that come out of your paycheck. Then you get your paycheck. You save that money. You have a budget surplus. You put in the money into the Roth IRA. It has to go into a Roth IRA. If it's a regular IRA or some other investment or just into stocks, you pay capital gains tax, which can either be short-term, long-term. We'll get into that in the next unit. However, if you put this in there and you don't touch it until 59 and a half, all of your capital gains are tax-free. So of that $3 million, you might put in like $500,000, $450,000 of contributions. You don't have to pay any of the $2.5 million in capital gains, the money you made, that compounding interest, that 9.5% rolling over year after year after year. You don't have to pay any capital gains tax, which is awesome. I love it. So great. We get taxed on so many things: sales tax, property tax, income, state income tax, federal tax, FICA tax. It just goes on and on and on and on. This is an awesome way to avoid taxes and on millions of dollars, which is really cool. But you have to start early, just like we talked about. You have to budget, you have to start early. At what age can I access my Roth IRA without penalty? Boom, same thing as 401k, 59 and a half. Okay, this is awesome. If your company doesn't issue a really nice 401k, if it's just a small match, take that small match. You can still do a Roth IRA as well. And you might still even have Social Security on top of it, okay? You can use all three of these vehicles. You could do other things. You can invest in real estate and rental properties. You can invest in other assets or royalties or different things. You can open up your own small business and sell that, or take on a partner that's a managing partner and you are a passive investor into your business. Whatever it is, there's so many different things that you can do, but these are some of the really, really cool things, but you have to do it early, right? Remember when we went back to that retirement tab and we saw how sad it was? My little amount of $258 over 42 years was a cool $1.5 million, but then if I started 10 years later, if I waited till I was 32, like, that's super sad, right? That's top flights and municipal golf courses. This is going down to Florida playing Pro V1s. All right, pretty cool stuff. I love it. If you have any questions, let me know. Make sure you have the questions on retirement plans. Make sure you have a budget surplus. This is a 50-point project. I want to give you guys all your points. If you have questions, let me know. Send me an email. Come talk to me during Thunderblock. All right, I'm out.